Joining us this morning, the analyst behind that call, Brennan Hawken of UBS. Brennan, I thought it was fascinating because it involves a company that just worked very hard to elevate their consumer exposure, but not as much as peers, as you point out, right?
Right, and actually, they just had their investor day and backed away from the consumer lending effort. To me, that was actually critically important, especially for the stock. The consumer, if they're going to continue to grow the consumer lending, that's a low multiple business, and then you run the risk of derating. Now that that has strategically been taken off the table, I think actually it's much more attractive, easier to analyze, easier to understand the outlook.
Where does it leave us in terms of capital markets activity? Are you betting the back half does see some heating up?
You know, it's certainly possible. You have the embedded optionality. The good news to me about Goldman, and especially when you're thinking about financials, the estimates have come down a lot. Past 6 months, estimates are down about 10% on 2024 numbers. Not even 23 is down even more. And so you've already seen the adjustment in the expectations around capital markets. The investment banking has basically been closed for a year, right? It's not new news. Think about what's been happening, though, more recently. March was incredibly active. We had bank failures. The funding side for regular banks, that's really squeezing. That's hurting the outlook, and it's going to really, really squeeze the earnings. And to me, given that we've already de-risked the investment banking outlook, you can rely on the investment banking outlook to a much greater degree than you can in other parts of financials. And so it just feels much easier to own a name like Goldman here. Plus, higher for longer, you know, we had ZIRP for over a decade. That really tamped down volatility in the markets. We're now seeing the last few years higher rates and what it can do to volatility. It doesn't always feel good, but certainly for a trading business, it's going to give you a lot of volume.
Right. It doesn't have basically it doesn't have the NIM, the net interest margin pressure that some of its competitors have, right? It doesn't have the exposure to consumer deposits and all the stuff that everybody's worried about with bank profiles. Is that in the stock? Is that fully appreciated?
It's already in the stock. Absolutely. It's a wholesale funded business. They have the Marcus consumer deposit platform. That's a high beta platform, but everybody already expected it to be a high beta platform, right? Everybody already has their money there. It's actually a pretty good platform. You get almost 4%. I've got a bunch of money there myself. But aside from that, nobody was thinking that they would benefit from cheap deposits or cheap funding. Everybody knows that Goldman has to wholesale fund. So the incremental news of what we've learned in the last month or so, it doesn't really hurt Goldman. It in fact, increased volatility helps them a bit.
When I think about the negative calls from the sell side in recent months, they seem to be cultural, right? How much backing does Solomon have among partners in the board? How is employee morale? Why have they fallen on the lists of companies that are highly sought after to work for? What do you make of those questions?
Sure. And it's certainly been a big topic on the media side. We don't hear as much on the investor side, those questions. With that being said, it is still fair. I think the consumer clarity helps a lot. I think that a lot of the concerns internally was that they were spending money on the consumer push, didn't have a lot of buy-in on the partners. Now that that's been reduced, the risk of that's been reduced, they've made clear that they're exiting and de-emphasizing. To me, that reduces that risk. Also, what I would say is that if you look at the share that they've gained in trading, the trading businesses, which are core, since 2019, they have gained 5 percentage points of market share in FICC and 1.1% of market share in equities. That's really, really encouraging, and that's building on the top position that they have in equities. So really outstanding franchise, and doesn't suggest what we're seeing in the market, doesn't line up with all of the news stories about the strife internal. And so it does seem as though that's a little more smoke than fire.